webinar where we'll be sharing a major upgrade to our flagship CPF portfolios. And we're introducing a name that you guys are going to be very familiar with, which is Dimensional. So we're introducing Dimensional into CPF Investment Scheme and then into our flagship portfolios. And quick intro, my name is Sam. I'm the Chairman and Chief Investment Officer at Endowus, and together with me, excited to have Min, who's our Head of Research at Endowus.
Hi, everyone. Nice to be here. Thank you for tuning in.
Great. So we're going to get right in, guys, and it feels great because I haven't done a webinar in so long, but we have to go through our regular disclaimers, which you'll see here as a licensed, MAS licensed entity here in Singapore. Also, if you have any questions, we'll use our usual Slido tool, and we'll always have at the top, top right-hand side, the CPF RPC hashtag for Slido. So if you forget, please just type it into any Slido. Really excited about today's webinar, but even more excited about all the upcoming webinars that we're going to release over the next 2 weeks, basically today and then on Friday. Will be the first of a series of webinars that Endowus has done together with Dimensional. So yours truly, I was able to spend some time with the founder of Dimensional, David Booth, in Austin, Texas, in their headquarters. I was able to spend some time also with the Nobel laureate and chief scientist of Dimensional Fund Advisors, Robert Merton. So Bob Merton obviously is the guy who invented the Merton Scholes model and a lot of innovative studies. He's also a renowned kind of thought leader in the retirement space. So I was able to spend time with him in Charlotte, North Carolina. And then we go back to Dimensional, Gerard O'Reilly, who's the co-CEO and co-CIO, and really the brains behind a lot of the innovative advancements that Dimensional has made in recent years. The 3 interviews will be starting this Friday with David Booth, next Wednesday with Bob Merton, and next Friday with Gerard O'Reilly. And you'll get notified of this if you sign up. So please go ahead with that. Today, I'm going to do a very quick introduction of Endowus and really jump deeper into the Dimensional funds that are being included into CPF and the update to the flagship portfolio and how that enhances the flagship portfolio in the CPF investment scheme. So for those of you who are joining us for the very first time, welcome. Endowus is really a very missional and purpose-driven company that is focused on empowering all of us, individuals and families, to invest better, to live better through independent, conflict-free advice, institutional access to great products, and a lot of curation that Min heads up as the head of research, and low, fair, transparent fees. And we are a relatively young company, but we're backed by some of the biggest names in the space with UBS, Citi, and MUFG, strategic investors and partners, as well as the Economic Development Board's Global Investment Arm, EDBI, and Singtel, local champions like that. And so we have been growing the business for several years now, really focused on these 5 core pillars of advice, access, cost, security, and technology. So the first and foremost, most important thing is advice, holistic, evidence-based, which is why Dimensional is an important partner of ours. And then really, in order to increase the chance and probability of success, we need to really focus on the individuals or the family's core important goals and focusing on these future liabilities and then bringing that back today to how you map out your risk asset allocation is critically important in enhancing that probability of success. So not based on speculation, but empirical evidence and really liabilities-based asset allocation focused in advisory services is what Endowus is really about. But in order to do that, we had to really uproot and transform the way financial products are distributed, the problem of access, the lack thereof. And this is exactly why we're doing this CPF flagship upgrade and bringing Dimensional into CPF investment scheme, because we need to improve the selection and the opportunities that are available to us as investors here in Singapore so that we can access some of the best products out there. We are agnostic and therefore work with every major global local fund managers who are the best manufacturers and investors for public markets, active, passive, systematic, quant. But also, as many of you would know, Endowus has really led the way in accessing private markets and hedge funds, some of the best multi-strategy hedge funds in the industry, so that every individual can invest in these best-in-class products at the lowest cost possible with much lower minimums and flexibility and liquidity as well built in. And with those building blocks, we build portfolios so that if you want to rely on the wonderful research that Min and the investment office does in selecting the funds and building portfolios, also Hugh Chung, our Chief Investment Advisory Officer, working together as a team of 12, building portfolios that are most suitable for you and gives you a much better access and probability to success with these core and satellite positions, short-term cash management solutions, as well as some of the best alternative investments, all with no sales or subscription charges, no transaction fees, and the innovative 100% cash back on trailer fees or access to institutional clean share classes. And that effort is really important because cost is everything when it comes to investing. And we know that fee-only alignment is important. We know that removing fees as much as possible enhances the returns for investors as well. And then finally, giving you security and comfort that all of your assets are safely secured. We don't have access to it. We can never touch your money. We work with UOB Kay Hian, the largest local broker, to custodize and invest your products into financial markets in the most efficient way. And then technology. We are a technology company that solves their access problem, solves the experience problem, solves the cost problem by leveraging technology and then automating the process so that you have the best experience, but also the best probability to success as well. And so Endowus has been growing for many years. We launched in 2019 in October. And now we've grown to over $8 billion Singaporean group assets, group client assets. We've raised almost $100 million of investment. And the middle part, more than $50 million in cost savings back to our clients through innovative trailer fee rebates and access to institutional clean share classes over that 5-6 year period. What is important, though, is this launch in 2019. We really started with the mission of helping individuals solve their long-term retirement problem. And that is why we really focused on the CPF Investment Scheme, building an end-to-end technology experience that didn't exist before or since our launch. So we are still the first and only digital advisor for CPF Investment Scheme. And we've been working with Dimensional for a long time to make this happen, bringing Dimensional into CPF Investment Scheme. That's why we're so excited to announce and introduce you to the 3 Dimensional funds into the CPF Investment Scheme. And for those of you who are less familiar with Dimensional or new, which I hope is not too many on this call, but if you are, then just a quick intro to Dimensional. It is probably the largest and most important factor investing giant in the world. They really led the charge in systematically investing into proven factors of returns and really a very diversified, low-cost way of investing. So it's a fun fact, and I discussed this with David Booth, the founder, in my interview with him. But we talk about Jack Bogle as being the founder of Vanguard, being the guy who innovated and invented passive index investing. But actually, Jack Bogle went to David Booth and Matt McCown, who was at Wells Fargo Investment at the time, which became Barclays, which became BlackRock, which is the largest passive index investor, to learn about passive index investing from these guys. And so Dimensional and David Booth was there from the beginning, 42 years ago in the 70s, and have really grown the business. And what's important is working together with a lot of financial advisors, guiding investors in the right way. Amazing resource.
Sam, sorry to cut in. I think your mic is okay. Now you're back.
Is it
We
working?
lost you.
All right. For some reason, I was lost. Sorry, guys, it's my AirPods. So Dimensional, 333 professionals globally, leading the systematic investing, focus on the proven factors returns. For equities, that's small size, relative value, and profitability. And fixed income is term, credit, and currency. I think a lot of this you guys will know, but really excited to be sharing with you the three core dimensional funds in fixed income and two in equities, which is developed market core, emerging market large cap core. And this will drive lower cost in terms of fees. It will improve the risk adjusted returns of the investments and really, give the best of all worlds, which is what the flagship does as a portfolio, being the best of passive, systematic, and active investments in across equities and fixed income. So with that, I'm going to hand over to Min to go through the details of the actual change in the portfolios and how that affects you. Over to you, Min.
Thank you, Sam. Good afternoon, everyone, and thank you for taking the time to tune in today. As Sam mentioned, I'm going to go through in detail the changes that we are recommending for the CPF portfolios. We can sum up the changes and the intended benefits into three key takeaways. Firstly, you see on the leftmost column, we are aiming to lower the total expense ratio of the entire portfolio series. And adding some of these dimensional funds that Sam had already introduced you to can help us towards that goal. On the second column, as a second takeaway, we also strive to ensure that the portfolio is not taking large bets on sectors and geographies. And part of the portfolio construction was centered around that objective, especially for the equity component. And the third benefit or the third takeaway on the rightmost column would be that we're trying to increase the beta exposure of the fixed income sleeve. And by that, we will in turn potentially increase the long-term return potential of the fixed income component in the portfolios. So what do I mean by beta? In simple terms, the beta of a fixed income portfolio really just measures how much the portfolio's value is expected to change in response to changes in the overall bond market. So if the beta is 1, which means that when the bond market moves up 1%, we would expect the fixed income portfolio to also move by 1%. So that's essentially what beta means. Similar to correlation. I mean, it's essentially correlation. So as you can see, the current fixed income portfolio tended to have lower beta, and we're trying to increase the beta so as to allow us to capture more of the upside. Next slide, please. Next slide, Sam, sorry. Thank you. Okay, so this table lists out the new allocations of each of the 6 CPF portfolios. In the 100% equity portfolio, which is all the way to the left, we are adding the Dimensional Core Equity Fund at a 25% weight, and the EM Large Cap Core Fund at a 9% weight. And all the way on the right is the 100% fixed income portfolio, and we will be adding the Dimensional Global Core Fixed Income Fund at a weight of 23%. And these are essentially going to be the target allocations for each of these portfolios. Next slide, please, Sam. This slide goes back to the key benefit or the takeaway number 1, which is why we are aiming to lower the total expense of ratio of the portfolios. I think Sam had already alluded to this in his earlier slides. This is because we are trying to control what we can in investing. Just like in life, you can only try to change things that you have control over. And one of the variables we can control in investing is cost. This chart here shows how different your investments can look just after 10 years if you are able to control the fees. So without any fees, this S&P 500, if you had invested in just S&P 500 10 years ago, without any fees, you would have made about $335 with your $100 investment. But if you have a fee of 50 basis points per annum or 0.5% per annum, you would have only made $319. And while that difference does not seem that large, If you expand that investment from $100 to say $100,000, that's essentially almost $26,000 in difference. So it can get up to quite a bit, especially with the power of compounding. Next slide, please, Sam. From here on, we take a deeper look at each of the different sleeves. So this is the CPF equity portfolio sleeve. To make room for the dimensional funds, we decided to reduce the weights in some of the existing funds. The Schroeder Global Emerging Markets Opportunities Fund, the Amundi Prime USA Fund, and the Amundi MSCI World Fund. These have been reduced. And what we did also, which is not shown here, is remove the FSSA Dividend Advantage Fund from the portfolio. And this is really just to try to reduce the overweight that we had in Asia. And we will explain later how the new portfolio looks versus the current portfolio. Next slide, please, Sam. As my mom likes to say, the proof is in the eating of the pudding. So here we are on this page. We show the different sectors using Morningstar sector classifications, which can look different, slightly different from this S&P GIG sector classification. The green bars refer to the allocations of the current portfolio, and the blue bars refer to the allocations of the new portfolios. We managed to reduce the large overweight, and I don't know if you can see, but essentially the large overweights, the green ones, in real estate and technology, and reduce the underweights to basic materials, communication services, and consumer cyclicals. So it's a lot tighter. The blue bars are a lot smaller in magnitude than the green bars. So this is what I mean by trying to reduce sector bets so as to eliminate some of the unknowns and just focus on the knowns, which are the premiums that Sam had mentioned earlier. Because the dimensional funds tend to have a value bias, they also have a healthy weight or exposure to more value-oriented sectors such as materials, industrials, and energy. And so that's why you have the more balanced portfolio, trying to balance out some of the growth tilts from other funds in the CPF portfolio. Next slide, please, Sam.
Yeah, and I think it's important that all of them now are less than 1 percentage point in deviation, as opposed to high deviations we saw in multiple sectors.
Yes, that's right. Thank you. So this is the geographical allocation and what it looks like. There was a hefty overweight, as I mentioned earlier, to Asia. You can see the two tall green bars. That's actually to developed Asia and developing Asia. And we removed the dividend advantage fund just to make the portfolio more balanced. As you can see all the way on the right, the blue bars are now a lot smaller relative to the green bars, and they really just represent the DM versus EM allocations. So we have reduced significantly the underweights and overweights. Next slide, please, Sam. Next, so on this page is really a deep dive of the fixed income sleeve. In order to make room for the Dimensional Global Core Fixed Income Fund, we removed the Franklin Western Asset Global Bond Trust and reduced the weight in East Spring Singapore Select Bond Fund. As for the other two, UOB and Amundi Global Aggregate Fund, there are no changes made. This is just to make sure that we're trying to bring the beta up and also to reduce the total expense ratio of the fund. And by doing actually incorporating these changes, we were able to do so by a substantial amount. Next slide, please. In terms of the sector allocations, the new portfolio is still very diversified, but with increased exposure to developed markets corporate, reduced exposure to government or sovereign debt, EM debt, and for securitized, basically it's about the same. The Dimensional Fixed Income Fund aims to harvest this fixed income fund aims to harvest the term and credit premia by dynamically changing exposures to different yield curves and the credit rating segments of the markets. So this adds the potential for higher returns and enables us to also move the beta up, as we mentioned earlier. Next slide, please. Lastly, to wrap up the changes on the portfolios, we look at the returns and the standard deviation figures, which are often used as a proxy for volatility or the risk of a portfolio. It's really just the changes in the returns. we see that for both the fixed income and equity portfolios, the historical returns or the backtested returns are higher, but there's also a slight increase in the standard deviation for both the sleeves over multiple time periods. The two leftmost columns are the CPF fixed income, 100% fixed income portfolio. You can see that there is quite a bit of increase, especially in year one for returns, and a little bit of increase in volatility. All the way on the right, the two CPF shows a current equity portfolio versus the new equity portfolio. There is a substantial increase in returns and a slight increase in terms of volatility. Next slide, please. So at this point, you're probably convinced that the new portfolios are what you would like to invest in, and are wondering how you can opt in to invest in these portfolios. We will initiate the RPC process sometime today. I believe we have already initiated it, so some of you might have already received an email and some will receive an email on this. So you can choose to accept the change anytime. You can choose to do so immediately, or you can wait a day or two. It's up to you. So, you can sit on it to see what works better for your portfolio. Next slide, please, Sam. What happens after you have accepted the RPC? So really, this slide is just showing you how to accept it. First, log in, just click on the notification and then review the recommendations. You can see all this information and the details of the portfolios in our Insights article. So if I'm moving through the slides too quickly, just be sure to download our Insights article and just peruse at your own convenience. And all the details that you want are there as well. And as I was asking, what happens after you have accepted the RPC? Can we go to the next slide? Thank you. Here are 3 things you should be aware of. We will redeem only what is necessary. We will sell out of funds that are no longer in the portfolio or where we have reduced allocations. So that means that if a fund has gone from 20% to 10%, we will sell out the excess 10%. We will also rebalance your portfolio back to the target allocations. Essentially, those target allocations are what I showed in a few slides back. The process will take about 5 to 10 business days to complete, and you may be out of the market for 1 to 2 days. But this is because after selling out of the funds that are no longer in the portfolio, we're waiting for the proceeds to come in, and then we will use those proceeds to invest in the new funds and increase allocations for existing funds. Of course, if you have any additional questions, please do reach out to our client advisors. They're always waiting online or over the phone to help you with what you need. Next slide, please. And with that, I'll turn you back to Sam. Thanks, Sam.
That's right. As Min just highlighted, we have a team of licensed representatives, client advisors who are here to help you. You can join this Experience Endowus session, which is held every Friday at 12 p.m. So it's a comfortable session that you can join and ask questions, or you can reach out to on the YouTube channel, to the Endowus email and contact details that are there. Once again, for those of you who are joining late, just want to highlight this amazing series of interviews. Amazing not because I did it, but because of the guests that I'm interviewing. David Booth, the founder of Dimensional, Robert Merton, Nobel laureate, and the chief scientist for Dimensional, and Gerard O'Reilly, who's the CEO and CIO, Chief Investment Officer, driving a lot of the innovations that are driving Dimensional forward. And these interviews will be spaced out this Friday with David Booth, next Wednesday with Bob Merton, next Friday with Gerard O'Reilly. And please sign up. If you miss it, it's okay because you can watch it later, but you do need to sign up so that you'll be notified. And, just want to highlight that Endowus, obviously, CPF has been a very important core mission and focus for the business, but we do serve a much broader community. So individuals, we're the only platform where you can invest your CPF SRS as well as your personal savings and private wealth. But we also serve families, we serve institutions and corporations. And missionally, we are very, very focused on filling the gap, standing in the gap to serve the underserved, which are foundations and charities, nonprofit organizations, and endowments. So that's really, really important to us. And also we do a lot of wealth education, investment education, financial literacy with employees of companies and societies, associations, etc. So I think it's really important that we are trying to bring endowment investing for all of us, and that really includes everybody. And with that, I'm gonna turn to Q&A. I think our Chief Client Officer, Sinting, and my colleagues in the investment office have been busily investing into, sorry, not investing, sorry, answering the Q&As on Slido. And Min, pick and choose anything that you would like to answer, but I'll pick a couple of them to begin with. And the first one is a question on how does your flagship portfolio compare to a simple world equity ETF investment? And this is a trick question because Dimensional has a fund called World Equity. And this is different from the MSCI World Equity. MSCI World Equity is actually just a developed market product. So it's an index fund that does only developed markets. So MSCI World Equity ETFs or index funds, because they're the same thing. We always say how ETFs are exchange traded funds. They're exchange traded open-ended mutual funds. Index funds are indexed open-ended mutual funds that are unlisted, that only provide you with daily liquidity, daily NAV. So it doesn't have the discounts and premiums and the intraday liquidity that an ETF would have, but they're underlying the exact same fund with equally low cost. And we have two world equity index products from BlackRock and Amundi, which are very low cost, 8 basis points and 10 basis points, I think. And so those funds are available if you want that MSCI World Equity exposure. So we have the products that are equivalent in performance and exposure as world equity. But as I mentioned, that's only a developed market equity product, and developed market has outperformed emerging market. So if you focus just on developed market versus a global fund, DM is always going to outperform, right, over the past decade. Whether that's going to continue in the future is a whole different question, and we'll need another 5-10 minutes to answer that. So I won't go there. But the other thing I wanted to say was that there is a Dimensional World Equity Fund. I don't think the questioner is asking that question, but just in case you are interested, the Dimensional World Equity is not a developed market. It's actually the global portfolio. So it has developed markets and emerging markets in there. Unfortunately, Dimensional did not onboard that fund into the CPF Investment Scheme. It gave us the flexibility to have a DM fund and an EM fund. If you combine it, it becomes a global product. And so not exactly the same as the Dimensional World Equity Fund, but a DM fund and an EM fund significantly gives you the broad global market exposure, very diversified, with more names than a passive index fund in most cases. So those products are available as well. The global flagship portfolio is supposed to be globally diversified. It includes developed markets and emerging markets. There was a period in 2000, from 99 to 2009, where emerging market massively outperformed developed markets. Since then, developed market has outperformed emerging markets. And so there are cycles. And if in the really long term, we believe in diversification as an important tool to diversify away risk. And therefore, we prefer a globally diversified portfolio. But even in that globally diversified portfolio, developed market represents the vast majority. And so you have great exposure to some of the best performing stocks. That's what we prefer. But if you want just DM exposure, we have wonderful low-cost passive index funds available on the FundSmart platform. So please reach out to our client advisors for any advice or discussions so we can point you in the right direction and find the most suitable investment for your investments. Thank you. Is there any questions you want to take, Min? Just jump in. I'm going to go one more, or do you want to do one?
No, you can do it, and then I'll do the next one.
No, you do it first. I mean, and then.
Okay. So there's a question on asking how we would compare the current CPF OA 100% equity portfolio against the proposed DFA CPF funds in terms of rewards and risks. So I'm guessing it's really the current version versus the new version. And I think we've addressed this, but just wanted to give more detail. The there's a lot more balanced exposure in terms of geography and also sectors. But the other thing to note was that the previous version actually has quite a slight growth tilt. It's not extreme, but there was a growth bias. So with this, with adding the dimensional funds, which tend to focus on the value factor, we were able to balance it out as well in terms of style exposure. So in terms of reward and risk, you can see that the historical returns show there is an improved return in terms of over the 1, 3, 5 years, but also a slight increase in standard deviation over the 1, 3, 5 years. And really, it's just we're trying to eliminate maybe just the stock selection piece and focus on some of the knowns, like the systematic investing, and just having more exposure to premiums such as value and small size, those that have been proven over the long term to have higher expected return than just the broad market. So hopefully that answers the question.
Yeah. Thank you, Min. And just want to highlight there's several questions here that we can address with this slide as well. The TER, the total expense ratio on the bottom left-hand side, somebody was asking about the expense ratio and the total cost of this new portfolio, is a range of 24 basis points, 0.24 to 0.36 for the current portfolio, the older one. And the new portfolio reduces the total expense ratio, which is the annual management fee, the fund management fee, plus the expense ratio on the ongoing management of the fund. So a lot of people just focus on the management fee that the fund manager takes. But what's important to is address both of these costs, because both of them take away from your returns. And reducing both is really critically important in improving returns. So without doing anything, by saving 3 to 10 basis points here, depending on which risk bucket that you choose, is a meaningful improvement. And we've been able to achieve that with the help of dimensional funds as they scale, because the CPF Investment Scheme funds are separate. As it scales, the TER will continue to go down. And Dimensional is one of the few companies where they aggressively bring down total expense ratios whenever the fund scales and costs come down. They reduce the TER and the management fee even on an ongoing basis at a regular cadence. So we've seen multiple rounds of Dimensional cutting fees for the benefit of investors and advisors like ourselves. And that's what's going to be something to look forward to as we move forward. The expense ratio will only go down as these funds scale. There was also some questions about the sector allocation. I think a lot of people were saying that, hey, you're reducing technology, you're reducing certain sectors. But as Min highlighted earlier on, we're not taking an active bet. We just happen to be overweight technology. Not only that, the technology weight, because it outperformed, has increased further, right? And with the shift, we are still overweight technology. So we're not reducing, meaning we're not underweight technology. We actually have more technology than what the index is telling us we should have. But it's a smaller overweight, which reduces the risk. So risk is about outliers. So if we have big active or tactical positions that are out of whack with the index, then we're actually taking more risk. So by taking these index constituents and sectors to a narrower dispersion, what is happening is we're reducing the sector risk. We're also reducing the geographical risk, and we're reducing the cost. So all of these things are done as a systematic process on our side with Min and the research team, focusing on optimizing the portfolio so that you guys will be exposed to less risk and generate the same risk-adjusted or better risk-adjusted returns over the long term. So that's another question. I think we've answered several questions along the way. Providence say they have brought in these funds, and Endowus also said that, may I know if the funds brought in by both companies are yes, they are absolutely identical funds, because Provident doesn't run the fund, Endowus does not run the fund. We are financial advisors, love Chris Tan and Provident and all the good things they do, but they, like us, are a financial advisor that serve end clients. Dimensional is the fund manager that builds the fund, manages the fund, and they're responsible. And this goes to a question earlier on, why did it take so long to bring it into CPF? Because it's something that if it was up to Endowus, we would have just done, but we're not the fund manager, right? We can't just bring in funds because the CPF investment scheme, there is a rigorous process really to protect the CPF members from being exposed to the right type of products that are suitable for them. There is a screening process and it does take a lot of time. The existing funds could not meet the criteria that CPF board had set to be included as a mutual fund or as a unit trust in the CPF investment scheme. So we had to launch new funds, work through the legal, the regulatory barriers, localize Sing dollar denominations, included into the rigorous CPF inclusion process, and only then did it become available. And as it's available, there are two partners that are important partners. Endowus is probably one of the largest global partners that Dimensional works with. And we, together with Provident, committed to Dimensional funds becoming available on our platform. And for us, especially because we had the flagship portfolios and the factor-based portfolios, we said that we would love to include Dimensional into the CPF investment scheme, flagship portfolios, and the factor portfolios. And so we actually worked together strategically with Dimensional, and Provident did as well. So in Singapore right now, with the fund launches into CPF investment scheme, Endowus and Provident are the only ways a retail investor or an individual investor can access these funds. Any other questions for you, Min?
Sam, did you address the question on why it took years for the dimensional funds to be CPF approved?
So I just addressed it just now. I just addressed it. The process, the rigorous process with CPF inclusion and the CPF board regulations, and also localizing the product, launching new funds, and then taking it into CPF took a long time. But we are finally there. It's something that Endowus really wanted to do from the beginning in 2017, 2019 when we launched CPF. It's just taken us a long time, and working through multiple parties and regulations and localizing the product, but we are finally here. So thank you for your patience and thank you for your interest in this. Okay.
There is also a question on how we came up with the figures shown and how they can serve as useful indicators for investors. Really, the figures are the proposed allocations are used using the oldest share class for the funds. So while the funds are really new, the other dimensional funds that are available for non-CPF investment are exactly the same as these funds that they've just been approved for CPF. And therefore, we just use the oldest share class to come up with the back testing and the historical returns. So that's how we came up with those numbers. And that is, it's not indicative. We won't say it's a representation of what's going to happen forward, but it's a representation of what happened in the past, and hopefully some kind of set some expectations for you of what's going to happen in the future.
Yep, great. There's some topics that are not directly related to the RPC, and so I do want to address that because it is important for our investors. The first one is from Tan Se Meng on interest rate is expected to drop by end of this year. My equity portfolio is currently up. Should I cash out then, buy back later, or switch to a bond portfolio? There is another question at the end. Jagger, thanks, Sam and Min. Timing of this portfolio change, especially with US elections where Trump trades are already happening. Do we see risk now or later? I think these questions are both, and then also there is a question about Flagship still has EM in it. Wouldn't there be risk of investing CPF since it already inherently has interest without investing if it's too volatile? All of these questions actually are, first of all, I want to address it by telling you what Flagship is, which is a globally diversified core portfolio, which is supposed to give you broad, diversified exposure to global markets. Global equities is 100% and made up of passive index funds and dimensional systematic investment process funds exposed to the factors returns, but both of them are very, very broadly diversified and giving you exposure to the global markets, right? That's the most important thing. Not DM, not certain sectors like technology, not the US, not EM. It's giving you broad exposure that is equivalent to the benchmark, which is the MSCI All Country World Index or other equivalent global benchmarks. Dimensional has its own benchmarks. So those things are globally passive, systematic equities, because active in equities over the long term does not always beat the benchmark. And so since we launched in 2019, the CPF Flagship Portfolio and the cash SRS portfolios have largely tracked the global indexes or have done slightly better, sometimes slightly worse, but largely tracked the global index. That's really critically important. That is a strategic asset allocation that is not affected by timing of the market, by what happens to US elections, whether there's a war or not, because the global market exposure allows you to compound returns over the long term, because over the long term, equity markets have given you a certain amount of returns. There is somebody who mentioned expected returns. And for you, I would really just talk about this flagship portfolio returning. Expected annualized return is a basis upon which the historical returns have given you, which is between 7 to 10%. The CPF flagship portfolio has generated almost 10% since launch. So it is actual proven track record of delivering good returns that are close to the global equity benchmarks. Fixed income is also very closely aligned to that global benchmark, which is the Bloomberg Global Ag. But we've done slightly better because we believe that there is still cause for alpha generation in fixed income because costs are very high. There is scale benefits. Hedging costs are higher because these are mostly Sing dollar denominated. There's inefficiencies in the market. And for various reasons, fixed income, we not only use the passive index for funds, we don't just use dimensional, but we also include active fixed income as well. Great managers like PIMCO or other managers who can generate alpha. And so that also has done well over the long term, largely tracking or slightly doing better than the benchmark portfolios. And so again, going back to the original question of markets are up, should I sell and come back in, or should I switch to the bond? Whether Trump wins or US elections or war, does that matter? The sector allocation shifts, and then also questions about whether we should be exposed to EM or not. All of these questions actually are a moot point in the case of flagship portfolios, because we are espousing that you do not try to time the market. When you want to adjust the return profile or the risk, then you change your asset allocation. So you change the asset allocation by increasing the fixed income weight because interest rates are high, and you feel that you want to minimize the volatility of future returns and reduce your equity, which is giving you returns. That's okay, but it has to be based on your risk appetite and why you're investing. If you're investing for the long term, we think that you should stay invested. And so those questions, I think, are, if you want to be tactical, then you can seek advice from our client advisors to see if there's anything that's out there that is suitable for you. We have, as you know, the whole range of flagship and core investment portfolios, but also satellite portfolios, income portfolios, short-term cash management solutions. We also have FundSmart, which has more than 250 funds selected by our investment office, only the best-in-class, lowest-cost funds. So all of those options are available because we want to make investing seamless, and also we want to provide the advice of selecting the best products, building portfolios in the right way, lowering the cost for you, and giving you the best experience so that you can invest with the best outcome in mind. Any other questions, Min?
There are two questions. Yeah, there are two questions on small caps that I'd like to address. So the first one is asking if we are looking into globally diversified small cap funds. And it's a timely question because yes, we are. We are looking into bringing on additional global small cap funds onto the platform. Not necessarily CPF OA approved, but they should be available on FundSmart. And currently we do have one, the Dimensional Global Targeted Value Fund. So something that you can take a look into that is also investing in SMID. Another one is asking why we don't have access to US small caps in the flagship portfolio. Actually, we do, because the Global Core Equity Fund from Dimensional that we just added goes all the way down to micro caps. So currently there is no dedicated allocation to small caps, but there is exposure to small and micro caps through that fund. And whether we would like to add another dedicated exposure is something that we'll continually look at to see whether it makes sense down the line. Over
But
to you,
obviously
Sam.
we
I
are
don't know if there are
limited
other
in,
questions.
yeah, obviously we are
Yeah.
still limited by the availability of funds, and so CPF has limitations. There was another question about US Amundi Prime US fund in CPF and whether there's a dimensional equivalent. There is a dimensional US core equity fund that is available for cash investors and SRS, but unfortunately it's not a fund that was included into the CPF investment scheme. So for now, Amundi Prime USA fund is a fantastic product. It's done great in terms of performance. It is the single lowest cost fund ever to exist in Singapore, cheaper than any ETF. So this is 0.05% all-in cost, 5 basis points, which is the cheapest fund ever to exist in Singapore, and still the cheapest fund, cheaper than any ETF listed in SGX or available elsewhere. So Amundi Prime USA fund is a fantastic fund that has done well, and I think that you can continue to gain exposure to that. But I guess it's the last question that we will address probably is what are the benefits of switching to factors? Is the return or cost better than the current flagship? Really, if you are, if you're a general investor and you want the global diversified exposure, I think the flagship is the best fund portfolio of choice. But there were some clients, I think, asking specifically for dimensional only funds, which you can either build yourself or as a single one-click option, you can build the factors portfolio. And we introduced some new funds into that cash SRS factors portfolio. And so if you are interested in exposing yourself to the academically, empirically proven factors of returns of small value and profitability, and all the other factors that actually Dimensional does a tremendous amount of research on the other factors, and sometimes use momentum and other factors to optimize the portfolio. And so there are a lot of factors here that are being exposed to, but the single biggest factor is beta, is market, right? The equity factor is a huge important thing, and so we need to understand what these things are. And if you are convinced and would like purely dimensional funds, we're the only platform that offers a purely dimensional factors portfolio on the Endowus platform that you can one-click and expose yourself to. There's no transaction cost or ongoing fees other than the management fee and Endowus fees, all transparently published as well. So please check that out. And I think that answers almost all of the questions that we've had so far, right?
Yep, that's right. I think we have answered all the questions.
Okay. And once again, guys, just really excited finally after 5 years of trying that we have these Endowus portfolios. CPF Endowus portfolios upgraded with dimensional funds in the CPF investment scheme. Please reach out to our client advisors at support@endowus.com or join our Experience Endowus sessions on Fridays if you want to ask questions or interact with our client advisors. And final call out again, save the day for these amazing interviews. These guys are the giants of the industry. David Booth, you guys might know Chicago Booth School of Business. That's his name. He founded and he was one of the really early pioneers in this space. Bob Merton, tremendous, insightful, scholar that is actually one of the most involved in day-to-day real-world application of theory into practice. And so Bob Merton, whether it's dimensional and funds and investing, but also retirement and trying to solve the pension crisis, Bob Merton is one of the foremost thought leaders in all of these spaces. So a tremendous conversation there. And Gerard O'Reilly really pioneering the innovative new spaces of academic research and then application through dimensional funds in real life. So a lot of insights from him as well. So thank you again for joining us, and please join us for these interviews that will be aired over the next 2 weeks. All of this, including today's session, will be available on YouTube if you want to watch it again. And that leaves me with just a thank you to Min, my colleague, all of my colleagues who made this webinar, and it sounds like an Oscar speech or something. But thank you again for joining us, and have a wonderful week ahead.
Thank you, everyone.
Hey, bye,
Have a
Min.
great one. Bye.